Securing the future financially remains one of the top priorities for everyone. One of the most sought-after investments for long-term wealth accumulation is growth investing. Growth investing is essentially the process of investing in companies, industries, or sectors that are currently growing and are expected to continue their expansion over a substantial period of time. Without further ado, in this episode, we'll be walking you through the steps involved in taking advantage of growth investing. Step 1. Prepare your finances. Growth investing starts with preparing your finances, having an effective and easy to follow routine backed by time-tested rules for when to buy, sell and hold. The stock market rises over the long term and also poses sharp drops without any warning, so it makes sense to buy stocks with money you don't need anytime soon. Buying stocks for a long term will not put you in a position to quickly sell during low moments of the market. Ideally, the low moment of the market is when to even buy more stocks. Therefore, as a growth investor, your biggest asset is a balance sheet because it will help to protect your finances and emotions during low moments of the stock market. Before investing in the stock market, the following are some of the financial bases you should cover. Maximize your cash flow by raising your income or cutting down on your expenses. Pay high interest card debt. Open and fund a brokerage account. Step 2. Get comfortable with growth approaches. Learning how to invest is challenging for many people, especially because of the fear of losing money. However, it's important to get comfortable with growth approaches because you can take advantage of compound interest to build a strong investment portfolio and build wealth for yourself. Before learning to understand growth investing, it's very important to understand who you are as an investor and what you're looking to gain in the stock market. These characteristics and your goals can have a big influence on your investing strategy. Understand the history of the stock you want to buy. If you're aware that the stock has always recovered from past dips, then it makes it easier not to sell your stock after a big drop. If you know that great stock returns will probably end badly, then it makes it easier to avoid being greedy when the stock market is doing well. It's critical to apply your strategies consistently and not jump from one approach to the other. There is nothing wrong with buying and selling investments if you have a solid investment plan and make your buys and sells based on that plan. The worst type of investing is to buy investments after they have gone way up in value and then sell them after they have dropped in value. Reading the following classic growth investing books can help you get comfortable with growth approaches. One Up on Wall Street. This book was written by Peter Lynch. The book explains how an investor can leverage a few characteristics to surpass the performance of most Wall Street analysts. Common Stocks and Uncommon Profits. This growth investing book was written by Philip Fisher to help individual investors to master the principles of growth investing. The book has helped notable investors like Warren Buffett and a host of other successful investors. Another way to get comfortable with growth approaches is to acquaint yourself with billionaire investors so that you can learn the dynamics of the stock market from them. Step 3. Stock selection. Growth investing is not a 100-meter sprint. In fact, it's a marathon. You need to start and stay energetic to give it a boost when the time is right. Start with 10% of your total portfolio of funds. Look for stocks that fall within your budget and find the best options. Slowly but surely, as your savings increase and your understanding of the market grows, you will have a portfolio of stocks that have been handpicked by you based on your investor profile. Since growth stocks are more volatile and aggressive than defensive stocks, it's important to pay attention to risks. Generally, a longer time horizon favors growth investing than defensive stocks. One good way to check whether the money you allocated to invest in growth stocks is too much is if your portfolio makes you anxious. If you're feeling too anxious, you may want to invest more in more diverse options instead of individual growth stocks. Buying growth funds. Investing in growth-based index funds gets a lot of positive press, and rightly so. Index funds at their best offer a low-cost way for investors to track popular stock and bond market indexes. In many cases, index funds outperform the majority of actively managed mutual funds. The most obvious advantage of growth-based index funds is that they have consistently beaten other types of funds in terms of total return. One major reason is that they generally have much lower management fees than other funds because they're passively managed. For example, the Vanguard Growth Index funds charge annual fees of less than 0.2%. Instead of having a manager actively trading and a research team analyzing securities and making recommendations, the index fund's portfolio just duplicates that of its designated index. Index funds hold investments until the index itself changes, which don't happen very often. So they also have lower transaction costs. Those lower costs can make a big difference in your returns, especially over the long term. What's more, by trading in and out of securities less frequently than actively managed funds do, index funds generate less taxable income that must be passed along to their shareholders. Index funds have still another tax advantage, because they buy new lots of securities in the index whenever investors put money into the fund. They may have hundreds or thousands of lots to choose from when selling a particular security. That means they sell the lots with the lowest capital gains and therefore the lowest tax bite. That is why the iShares Russell 1000 Growth ETF is an attractive investment for investors who want diversity beyond just the 500 stocks that make up the S&P 500. Screening for growth stocks. Stock screening is a tool that investors can use to filter a large database of stocks into a more manageable list of stocks that qualify for further analysis. Stock screening tools can be web-based tools or downloadable software. There are some free screeners out there, as well as more advanced programs that can be quite costly. When trying to get as much return as you can for the least amount of risk, your number one concern should be to buy individual growth stocks. While having low fees and managing your own tax situation is good, buying individual stocks come with its own risks. Screen the following factors when looking to trade growth stocks. High return on invested capital. The profits that the company generates each year, or the average growth in earnings per share. The percentage of sales a company turns into profits. Historical growth in sales or revenue. While stock screening, also watch out for some red flags like excessive debt. Though this varies by industry, in general, great growth companies have a clean balance sheet. Profits or sales are constantly falling. If there is a recent management shakeup and it affects the CEO position. If the companies carry a low market cap less than $500 million. If the company had sustained annual net loss consecutively for the past 3 years. This is a red flag for more growth investors. Selecting stocks can be a difficult and tedious process, and stock screening programs can help you by saving time, removing emotion and behavioral biases from the investment decision-making process, uncovering investments you may not have known about. Step 4. Maximize returns. Even though growth investing is highly volatile, it still makes sense to adjust your portfolio or sell a stock due to the following reasons. 1. Sell a stock whose value has risen above the estimated value and reinvest the profit in more reasonably priced investments. 2. Rebalance your portfolio by reducing your exposure if a particular portion of your investment has grown in value such that it dominates your portfolio. 3. If the company is experiencing any crises such that it negatively affects your investment plans, it makes sense to sell the stocks. If you have done your due diligence before investing in any growth stocks, your job is to sit back and relax while you watch your portfolio grows in the next 5 to 10 or 15 years. That's it for this episode. If you found the information here useful, hit that like button. And if you want to support us even more, buy us a coffee from the link in the description. If you'd like to see more episodes on financial advice, hit that subscribe button and turn on the notifications for our latest updates. Good luck and see you in the next episode.